For more on today's market pullback, we're joined now by Peter Berezin, Chief Global Investment Strategist at BCA Research. It's good to have you join us, sir. Thanks so much.
My pleasure.
So we know now markets have shown resilience to tariff uncertainty in the past. Is the downward trend we're seeing to end the day today related to tariff uncertainty and that Supreme Court ruling last week, or is it something else, do you think?
I think right now it's mainly about tariffs, but I don't think it's going to last. My advice to anyone watching is don't listen to what Trump says, ever, because he'll say something one day and just say something else the next day. Focus on the constraints that he faces. Right now, the major political issues around affordability and whether Trump admits it or not, tariffs have raised prices, which means that he's going to be looking for ways to sort of pare back the tariffs regardless of what the Supreme Court has said. So I think tariffs are going to not be a key issue for the economy or for financial markets over the coming months. I think it's going to be much more of a story about AI, and particularly the ability of AI companies to monetize their technology.
You've also expressed optimism about the economy in light of current U.S. fiscal spending, but what macro factors do you think could potentially undermine that outlook?
I think the big risk is that we have a repeat of what happened in 2000, 2001. In March 2000, everything looked fine. The economy was gangbusters. Less than 1 year later, it was in recession. What happened? Well, what happened was that stocks went down. That led to a negative wealth effect. It led to less investment spending, and that pushed the economy into recession. I think there's a risk that I certainly see of something like that happening again, if, again, investors become somewhat disenchanted with the whole AI narrative.
Do you think that recent AI capital expenditures are driving GDP growth and kind of masking weakness in other sectors at the moment? And then I want to get back to your comment on the recession as well.
Well, it certainly has had an effect. We estimate that investment in computer technology lifted growth by around 0.5 percentage point in Q4. Now, some of that is imports, so I need to take it out. But I think the more important effect has just been through the stock market. Real personal disposable income in December was less than what it was in April. There hasn't been any income growth now for over 8 months, and yet personal consumption expenditures, consumer spending has gone up. Why did that happen? Because the savings rate fell. And why the savings rate fell? Because people were digging into their savings and tapping the equity that they accumulated from the rising stock market. The risk is that this goes into reverse.
Is that one of the biggest factors then that could push the U.S. economy into a recession?
Yeah, absolutely. I mean, of course, you can come up with other possibilities, but I think the biggest risk to the economy is that the AI bubble does turn out to be a bubble. It bursts and it brings the economy down with it. I think that's by far the most pressing issue at the moment.
Do you think that that's likely? I mean, there's a lot of talk about this AI bubble. Is it a bubble? I mean, are companies spending too much? Is all of that reason for concern, I guess, for investors?
Yeah, absolutely. I mean, if you look at the analyst estimates right now, the hyperscalers are on track to invest something like $700 billion in this year. By 2030, if these estimates prove to be accurate, they'll be holding something in the order of $2 trillion in AI-related assets. Now, the average depreciation rate on these assets is around 20%, so average lifespan of about 5 years. 20% of $2 trillion is $400 billion. That's the annual depreciation charge that they face in 5 years' time. That's equal to their combined profits in 2025. So unless they can grow those earnings and sales very, very strongly, they're not going to be able to monetize all that investment. And by the way, we have a template for what that could look like. Back in 2000, Cisco was the world's most valuable company. The presumption at that time was that companies would continue to spend a lot of money on internet infrastructure. What happened, I think, is quite illuminating. Over the last 25 years, data traffic over the internet has grown by 42% annualized, and yet the amount of money spent on internet infrastructure has gone down as a share of GDP. So if these AI companies figure out how to run their models more efficiently, we won't need these trillions of dollars in investment in data centers.
Is that likely? Like, I wonder about, like, due to these concerns that investors have on these big spending from these companies, are hyperscalers likely to kind of scale back investment plans in the coming months to try to meet investors in the middle?
They're not going to scale down the investment right now, but they're going to do that probably later this year and next year. And the reason we know that is because investors are now starting to punish these companies for massive capex. There was a survey done by B of A just a few months ago, which they updated more recently, which shows that for the first time in the history of their survey, and that survey goes back a long time, investors now think that companies are spending too much on capex. So no company wants to see its share price go down. If investors start to punish companies for excessive capex, you're going to get less capex later this year.
Okay, very interesting. We'll have to leave it there. We're out of time. That was Peter Berezin, Chief Global Investment Strategist at BCA Research. Appreciate your time. Thank you.
Thank you.